On January 13, 2026, federal regulators seized Metropolitan Capital Bank and Trust. Assets, $261 million. Status, insolvent. The FDIC took over as receiver and executed a purchase and assumption agreement with First Independence Bank out of Detroit by Friday evening. This was the first bank failure in the second half of 2025. Before that, Santa Ana Nacional in June 2025. Before that, Pulaski Savings in January 2025. Two bank failures, exactly 1 year apart, January 2025, January 2026. The pattern is undeniable. I know what you're thinking. That bank was small. $261 million in assets. Compared to JP Morgan or Bank of America, it's a speck of dust. It's statistically irrelevant. You would be making a fatal mistake if you believe that. The size doesn't matter. Never did. Think about a dam. It's not the hole that matters. It's the water behind it. And right now, that water is rising faster than anyone anticipated. The Federal Reserve spent 2 years pumping interest rates higher to fight inflation. They told us the medicine was necessary. The pain was temporary. The system could handle it. They were wrong. Banks took that poison and held it in their portfolio like a sleeping snake. For 18 months, nothing happened. The snake was dormant. You could almost forget it was there. But poison doesn't disappear. It works slowly. It compounds. And now the snake is waking up. That small bank failure. That's the first rattle of the snake. The FDIC maintains a confidential list of problem banks. You will never see that list. The regulators keep it classified. We only find out which banks are on it after the doors lock on Friday nights. But here's what the data reveals anyway. Delinquency rates on commercial mortgages just hit a 10-year high. That's the smoking gun. Not isolated failures. Not bad management at a few institutions. This is systemic collapse. Commercial real estate delinquencies haven't been this bad since 2015. When borrowers stop paying, banks absorb the losses directly to their capital. When capital dries up, the bank is finished. Metropolitan Capital was a commercial bank. They served small and medium-sized businesses in Illinois. Those exact borrowers are getting crushed right now by inflation, high interest rates, and a frozen credit market. When your loans stop performing, your bank dies. The pattern tells us this isn't random. It's cyclical. Loans mature. Borrowers can't refinance at new rate. The math breaks. The bank fails. We're in the maturity wall window right now. The disease spreading through the banking system has a name: commercial real estate. For 50 years, this was the safest loan a bank could make. Borrow $10 million for an office building. Collect rent. Rent, pay, the bank. Buildings appreciate. Everyone wins. Post-pandemic destroyed that entire equation. Office towers are empty. Lights are off. Remote work killed the office market. In major cities, office vacancy rates exceed 25%. In some markets, they've reached 40%. Buildings that cost $20 million now sell for $12 million. That's a 40% loss in asset value. Here's the trap banks fell into. A borrower took a $10 million loan at 3% 5 years ago for a commercial property. Today, that property is worth $6 million. The loan matures. Today, the borrower cannot refinance at 8%. The math doesn't work. The borrower tells the bank, "I can't pay." The bank faces a choice. Take the $4 million loss now, or extend the loan and pretend it's still performing. Banks chose extend and pretend. It's standard practice. Technically, the loan is still current, but it's a zombie. It's dead, just not buried yet. You can only pretend for so long. $2 trillion in commercial real estate debt comes due between now and 2027. Most of it is held by regional banks, the same banks bleeding deposits, the same banks running out of capital. When this maturity wall hits, the dominoes accelerate. Metropolitan Capital didn't have a line of customers out the door. No panic. No crowds. No media circus. It bled to death digitally, invisibly, silently. Millions of customers got a notification on their phones. They saw the news. They clicked. A wire transfer executed, billions of dollars vanished in seconds. The bank's capital evaporated faster than management could respond. This is the banking crisis of 2026. It moves at digital speed. A traditional bank run took hours or days. Customers had to physically go to the bank. There was time to coordinate a response. Digital runs happen in minutes, nanoseconds. Trillions of dollars can move before you finish your morning coffee. The regulators are equipped with analog tools. They're bringing a knife to a digital war. Metropolitan Capital lost its deposit base before the FDIC even picked up the phone. By Friday, the bank was already gone. The announcement just made it official. This is the new velocity of collapse in 2026. The Federal Reserve created this problem and now has no solution. They kept interest rates high for 18 to 24 months to fight inflation. The strategy was intentional. High rates slow the economy. Fewer loans. Less spending. Less demand. Prices stabilize. But high rates have a casualty count. That casualty is the banking system. Banks hold portfolios of old loans made at 3% and 4%. When rates went to 6, 7, 8%. Those old loans became worthless on the balance sheet. New capital didn't flow in. Old capital drained out. Banks got trapped. Now the Fed faces an impossible choice. Cut rates aggressively and risk inflation exploding. Keep rates high and watch banks collapse in slow motion. There's no third option. They chose the slow bleed. They won't cut rates aggressively. They won't raise them either. They'll maintain this holding pattern while regional banks systematically fail. Some will merge. Some will be acquired. Some will go under. This is not a 2008-style crash that was violent, sudden, visible. This is a slow asphyxiation, a gradual extraction of capital, a methodical dismantling of community banking. Metropolitan Capital had $261 million in assets. In the grand scheme, irrelevant. But do you know how much commercial real estate debt matures between now and 2027? $2 trillion. $2 trillion. Guess who holds most of that debt? Small, regional banks. The same banks that are already struggling. The same banks that are bleeding deposits. The same banks that are running out of options. That's a tidal wave. And we're standing on the beach watching it form. Most of that debt needs refinancing. But refinancing today is exponentially more expensive than the original loan. A property that was financed at 3% 5 years ago now needs refinancing at 8%. The math doesn't work. The Burra walks. The bank takes the loss. The capital evaporates. Multiply that scenario across thousands of institutions, and suddenly you understand why the regulators are moving so aggressively. They know what's coming. They're trying to execute a controlled demolition. They want the weak banks to fail in an orderly fashion rather than in a panic. But controlled demolitions are unpredictable. Here's the mechanism that accelerates the collapse. It's called deposit flight. When depositors start to doubt their bank's safety, they don't wait. They move their money to the giants. JP Morgan, Bank of America, Wells Fargo. The mega banks that are too big to fail. Smart money leaves first. Institutional depositors. Business accounts. They exit to safety. That leaves the retail depositor. Regular people. Business owners dependent on stable banking. This creates a death spiral. As deposits leave, the bank has less capital. With less capital, the bank's situation, the deterioration causes more deposits to leave. It accelerates. Once it starts, it's nearly impossible to stop. Here's the critical detail. The FDIC insures deposits up to $250,000 per account holder per bank. That's the official limit. In 2023, the government temporarily protected all deposits at failed banks. But there's no guarantee they'll do that again. If you run a business with a $500,000 payroll account, you're only covered for $250,000. The other $250,000 is at risk. If the bank fails, that money is gone. That forces you to become a risk manager of your own capital. You cannot blindly trust that your bank will open on Monday just because it opened on Friday. When Metropolitan Capital Bank failed, the FDIC estimated the cost to the insurance fund, $20.7 million. That's real money. That's a real hole in the federal insurance system, and the regulators are quick to say, taxpayers don't pay for it. The cost comes from fees charged to member banks. They claim